Welcome, podcast friends. We have a fantastic episode for you today. Last year, we brought listeners the entire volume of The Best Investment Writing Volume 3 in audio format right here on the podcast. Listeners loved it, so we're running it back again this year for The Best Investment Writing Volume 4. You'll hear from some of the most respected money managers and investment researchers from all over the planet.
Hi, this is Anil Rao. Thank you for taking the time to listen today. I am in the Equity Research Group at MSCI, which is a provider of research-based indexes and analytics. To learn more about us, you can find us at msci.com. Today, I'm going to read a piece from February 2019 titled Game of Homes, Revisiting the Home Bias. While it's a year old, I think you'll find the message still relevant. The accompanying plots for this reading can be found by searching for Game of Homes on the msci.com site. With that, let's begin. Game of Homes. Is winter coming for the domestic equity bias? U.S. wealth advisors' allocation models have a considerable overweight to U.S. equities when compared to a capitalization-weighted benchmark. Although historical signals of a U.S. slowdown show signs of abating, including last month's inversion of the U.S. yield curve, asset allocators with a U.S. equity overweight could still be exposed to an additional source of equity risk, home bias risk. In this post, we borrow concepts from institutional investor benchmarks and address two questions related to the risk and return of a U.S. home bias for wealth advisors. First, can we quantify this risk in an allocation? And secondly, what has happened when U.S. stocks ended previous multi-year runs of outperformance? Return of the MAC. Model portfolios have gained traction with wealth advisors as starting points to meet clients' return objectives. At its simplest, an allocation model consists of indexes and target weights, to which tactical views and active management can be added. In this respect, a model serves a similar purpose to an institutional investor's reference benchmark. To measure risk, we compare an allocation model with a U.S. home bias and one without, both with a moderately aggressive allocation of 60% equity and 40% fixed income. We represent the equity portion of our no bias allocation using the MSCI All Country World Investable Market Index, which contains no home bias, and a Bank of America Merrill Lynch 7 to 10 year global government bond index for our fixed income allocation. This serves as our reference allocation model throughout the exercise, with data as of February 2019. We next impose a 15% overweight to U.S. equities, funded by a 10% and 5% underweight to international and emerging market stocks, respectively. This serves as our home-biased allocation model. Our first comparison attributes the active risk, or the tracking error, of the home-biased model to the reference allocation model, using the MSCI Multi-Asset Class Factor Model, or MAC model. Risk models link our hypothetical decision, that is overweight the U.S., to an investment outcome, active risk. The results are shown in the first plot. I'll describe that plot here. Home bias added significant active risk. The exhibit likely gives pause. Home bias alone added over 70 basis points of active risk. This is before any active managers are added or any tactical views to the equity or fixed income allocations are implemented. A bias toward U.S. equities also introduced this market's overweights to certain sectors, such as information technology and financials, and to style factors such as momentum. Yet, the active risk due to sectors and style factors, the orange region in the exhibit, was dwarfed by that of the country decisions, the exhibit's blue regions. But did country decisions influence returns? What's gone up has come down. Before we can answer that, let's look in more detail at historical home biases around the world. In the second plot, we show the returns to 100% home bias for the major developed markets. Each plot can be interpreted as the relative return of the respective representative country index, for example, the MSCI USA index, over one covering the rest of the world. For example, the MSCI World ex-USA index. The plot shows that over the last 2 decades, a US bias showed significant outperformance, albeit with periods of sharp declines. As we've shown before, this cyclicality was closely correlated with the broad equity market as well as commodity and real estate returns. But a different picture emerges when looking at the deeper history and across markets. When the US suffered an extended stock slump during the 1970s to the 1990s, Japanese stocks soared, and then gave back all their gains during the subsequent decades. Canada's stock market suffered through a rapid rise and fall during the early 1980s. In fact, we see a pattern that country-specific rallies have come with drawdown risk, at least in the countries that we've looked at, including the United States, Canada, Japan, Australia, the EMU, and the UK. Examining the last time the US underperformed international markets. To quantify how much the home-biased allocation trailed the reference allocation, we use a recent period of drawdown in the US home bias. The final exhibit shows the 3-year rolling returns for the US home bias and the 3-year rolling returns relative to the reference allocation model from January 1995 to February of 2019. As expected, the two return patterns were closely related. On the plot, we highlight a portion which follows the dot-com bubble through the financial crisis of 2008, which corresponds to an extended period when US stocks trailed international stocks. By mid-2008, they had fallen behind by 20%. The home-biased allocation model followed suit, trailing the reference model by 4% at its trough. Over the course of this 5-year period, the home bias model trailed the reference allocation model by 70 basis points annually, with 100 basis points of active risk, comparable to the level of active risk highlighted in our first exhibit. In summary, equity allocations with significant US bias have enjoyed a long summer of outperformance. But history has shown that winds can shift and grow cold and usher in an extended winter of negative relative returns. Thank you again, and I'd like to thank my colleagues Limin Zhao and Andrew Dumond for their contributions to this post.
Hi, this is Bhansali. I'm the founder and CIO of Longtail Alpha. We're a manager in Newport Beach, California, and we focus mostly on tail risk-related strategies. And Meb Faber and I have spoken a few times about markets and the various opportunities that you get when things get too distorted. You can find us at longtailalpha.com. And I also have a couple of books, one of them being on tail risk hedging. I started with a background in theoretical physics and then went on to do analytics and portfolio management at PIMCO before starting Longtail Alpha in 2015. So today what I'm going to do is I'm going to read a piece related to negatively yielding bonds. It was published in Forbes.com on June 17, 2019, and the title was Trading Sardines, the Case of Currency Hedged Negatively Yielding Bonds. So here it is. You might have heard the story about these 3 traders who decided to go into the business of trading sardines. By the way, this is an old Wall Street story, so I'm retelling it with some embellishments. The first trader bought a can of sardines for $5. Then he went and sold the same can of sardines to the second trader for $10, doubling his money in the process. The second trader again doubled his money by selling the can of sardines to the third trader for $20. Now, the third trader, who was pretty smart, and he knew that he was overpaying for the sardines, said to himself, well, I'm going to buy it for this high price, but if the markets for sardines crashed, at least I will have a can of sardines to eat, so I'll just open it and eat it. Well, the market did crash, and he opened the can to find out that the sardines were rotten. So he probably went to the trader who had sold him that bad can of sardines and said, these sardines are no good. to obviously which the second trader responded, of course, they're no good for eating. They are trading sardines. So you might have heard this. And how does it apply to bond markets? So let's get into that now. So almost $10 trillion worth of the world's government bonds, when I wrote this, were trading at negative yields. Now it's probably closer to 20 trillion. And with the Fed and other central banks pumping in a lot of money into the system, it's possible that yields might go even further negative on a lot of the bond markets that are out there. So these bond markets are trading like these sardines. When a bond has negative yield, like a majority of these bond markets in Germany and Japan do today, the bonds are really being bought for trading, not for holding as investments. Unless we somehow undertake some sort of financial alchemy to figuratively turn this garbage into gold or vice versa, gold into garbage. Now, when if yields rise, a 10-year German Bund that is trading close to negative 40 basis points when I wrote this paper, negative 25 basis points nominal yield, will almost certainly lose a good part of its principal. And for those who hold it to maturity, it will also provide absolutely no income for their investment because they're paying money to hold this bond. In addition to parting with their principal, they're also paying effectively a coupon to hold this bond. So in other words, unless the current holders of these bonds are able to trade them to someone else before they lose value, they will likely find that these bonds were neither a good term investment nor a diversifier and not a provider of any sort of return. So now let's turn to the financial alchemy that in the short run can potentially turn these negatively yielding bonds into positively yielding bonds. So readers know that due to interest rate parity, a currency with lower interest rates trades at a higher exchange rate in the future. For instance, if you look at the exchange rate versus the euro or the US dollar, the implied forward exchange rate is very much tradable because you can change the forward exchange rate as a swap or just as a one shot forward, is basically calculated based on the interest rate differential times the basis swap. And it's about, at the writing of this paper, was about 3 cents per euro higher than the spot exchange rate. So the euro was trading at a premium to the US dollar because the euro interest rates were so much lower than the US interest rates. And again, the source for all of this data is from the Bloomberg taken at that time and then again recently. The implied forward exchange rate for any pair of currencies is thus determined by the spot exchange rate, the differential of the money market rates or whatever that tenor is, and the cross-currency basis swap, which essentially measures the supply and demand mismatch for the two currencies. Now, for this discussion, we'll just ignore the basis swap. It's small and it's variable. Sometimes it can get large, but we don't really care for this discussion because we want to focus on the important features. The only thing that the listener needs to know now is that if he or she buys a German Bund at a negative yield, so let's say of 25 basis points, then if he hedges the currency risk by selling the euro currency forward to convert the proceeds over the hedge horizon into dollars, he is selling the forward exchange rate at a higher price than the spot exchange rate. So the difference between the forward exchange rate and the spot exchange rate can then be considered as an additional yield or carry that's actually coming from the hedge. So even though the bond has negative yield, the hedge creates a positive carry. Now, in the example that I gave you, where the differential is 3%, this forward currency hedging generates 3% yield. So you take 3% and add it to the negative 25 basis points, and voila, you've got a negatively yielding 10-year German Bund now yielding positive 2.75% for a US investor. Similarly, a 3-month German Bund yielding negative 50 basis points will become a 2.5% hedging yield in this example. And a 2-year Bund will become, as of that writing, 2.3%. Now, yields have compressed quite a bit. The interest rate differential has compressed quite a bit since then, but many of these arithmetic calculations still hold. In other words, you can still turn negatively yielding bonds into positively yielding bonds just through the act of hedging. Now, look at it from the perspective of a euro-based investor. The act of hedging the currency risk reduces the yield of a 10-year maturity treasury note to negative 83 basis points. So a positively yielding bond at that time, positively yielding US treasury note, turns into a negatively yielding treasury note once you hedge it. In other words, it converts a positively US yield to negatively yields for a euro-based investor. Okay, so the chart in the paper that's on Forbes, you can see the various combinations for the US, Euro, and Japanese 10-year maturity government bonds from the perspective of investors in all these different currencies and countries. So even though every country in this list has a much lower unhedged yield than the US Treasury, and here I had a lone exception being Italy, which we'll also address in a second, the hedge yields for every country's bond is higher than the yield of the US 10-year Treasury. This is an example of the carry trade at its finest and potentially at its most dangerous. By taking a long-term, low-yielding asset and by using a derivative contract, the low yield is now turned into a high yield temporarily, and vice versa. Now, the state of affairs where the US Treasury's lower hedge yield than any other country is not completely an accident. Global central banks are easing policy pretty aggressively, and as of this writing, the US had not eased policy aggressively. Subsequently, it has eased policy quite substantially, like I commented on during that write-up. And in the post-COVID environment, yields have indeed in the US been cut quite drastically. Now, the lower policy rates in foreign countries result in carry benefits both in their internal market and also in the external market. So let's get into that for a second. For example, in Europe, very negatively yielding short-term yields, for example, short-term yields went down to about, I think, negative 90 basis points, result in positive carry even for a 10-year bond at negative 25 basis points for internal European buyers, such as indexers or banks in Europe. This is because if they buy a bond at negative 0.25, then with a fixed yield curve shape, the bond rolls down towards the more negative, shorter term yield, which results in a positive total return. So even though the yield itself is negative, the roll down and carry result in a positive expected return. Now, the increasing target 2 deficits, that's the balance of the central banks between the Italian central bank and the German central bank. And others are indeed a symptom of the fact that money is being recycled from Italy back into German bonds, presumably because despite negative yields, the carry and safety of being in bonds is worth the risk to Italian holders of euros and of Italian bonds. And obviously, the haircut on bonds is much lower, so the bonds can be used for repo and for other financing operations. In addition, by reducing short-term interest rates and the consequent application of the covered interest rate parity relationship, the central banks are also encouraging, unknowingly possibly, the kind of speculation that has been discussed just a few minutes ago, that by external buying of negatively yielding assets and converting them to positively yielding assets, you're allowing for external arbitrage. Now, this state of affairs is not the first time. It might sound unique, but it has a very classic life cycle, and it is deeply related to other forms of carry trades. The currency carry trade is also very deeply related to the volatility in currencies and other asset classes. And I wrote a paper in the Journal of Fixed Income on this topic a few years ago. The fact that currency volatility has remained incredibly low over the last decade has mitigated, so far, forced unwinds of leverage in this carry trade. But the question is, can it last indefinitely? And currency volatility is extremely low, so people think that there is no risk in currency carry trades. But as we know, when it unwinds in a very rapid and uncontrolled fashion. Now, one scenario in which currency volatility can rise sharply is a hiccup in risk assets that results in a rush into US fixed income assets for just protection of portfolios or due to an aggressive rate cut by the Fed. So I didn't know this when I wrote the paper, but since then the Fed has slashed rates all the way back down to zero. This would result in a substantial narrowing of the interest rate differential between US rates and foreign rates, assuming that European rates don't go further negative or even start rising at the same speed. So this results in a very sharp fall in the forward exchange rate. And this scenario could create a much lower yield pickup when the currency hedges are rolled forward, resulting in much less demand for these negatively yielding foreign bonds at their already existing low yields. And to a certain degree, this happened, but the European Central Bank stepped in again to purchase a very large amount of those negatively yielding bonds. The other scenario, which is almost non-existent in the collective consciousness, is that it is possible that the European short rates can rise if there is a sharp rise or change in the philosophy of the ECB. Now, when I wrote this, Draghi was still the ECB president. Since then, the president has changed, and I had expected the policy to be somewhat more hawkish, but it turns out that the policy of Christine Lagarde is actually just as dovish, maybe even more so. So this scenario has clearly not worked out as I had anticipated. But if rates at some point start to rise for whatever reason, because of more issuance, increasing deficits, or some of the legal ramifications of the court judgment, of the judicial court judgment in Germany, it is possible that short rates in Europe could start rising. And hence the pickup from the yield differential would be substantially narrowed. This is not a high probability forecast, but just a risk to be very aware of. Now let us apply the same analysis for a Japanese yen-based investor and then a euro-based investor. For a yen-based investor, the same table shows that US Treasuries are the worst yield of a bunch on a hedged yield basis. They're actually very negative. So in this case, because of financial alchemy or anti-alchemy, this time gold, US Treasuries, is being converted into dirt. But the question then leads, one led to is, should we prefer to buy US 10-year Treasuries at a yield of, at this time, 2.08% unhedged, or Italy at that time was 2.52 on a hedged basis? In the first case, if we had preferred to buy unhedged US Treasuries, we would be taking currency risk, but no credit risk. In the second case, if we are taking no currency risk, but we are taking a whole amount of Italian credit risk. In a late cycle environment, credit risk can be more dangerous than currency risk. For a European-based investor, France provides no yield, and Italy provides the only other positive yield. Because of the hedging, the US is still again at the bottom of the whole yield curve across globe. What is not shown in this chart was that for a US-based investor, but its fact was true, the longest duration German bonds, which at the time of the writing was 32 basis points, currently they're actually close to 0%, actually yielded 3.3%. Currently they'll be yielding much less than that. And for a Euro investor, the 30-year US bond would only yield negative 35 basis points. In other words, even as monetary policy was easy, investors would be tempted by the yields in the longest, most duration sensitive part of the yield curve, primarily because of the currency hedge carry. So finally, putting it all together, the point is this: whenever there's a type of alchemy that turns high into low and low into high, secondly, it uses a yield curve mismatch. Third, it is exposed to shocks to volatility. Fourth, it uses a derivative contract that needs to be continuously rolled. And fifth, it depends on central bank policy for survival of its benefits and returns and so on. One should get really, really cautious and careful. And in the case of the global government bond markets, the currency hedging tail is indeed wagging the so-called bond dog. Just like yield curve inversions within one currency can cause mayhem to bond markets by upsetting the carry arbitrage between maturities, which is a very common trade, the sudden collapse in interest rate differentials, upward shocks to volatility or to forward exchange rates between two different currencies can create the same sort of chaos in those currency markets and currency option markets. It is frequently said there are no bad bonds, only bad prices. And the currency hedged bond markets are a great example of how trading sardines are being created in the global bond markets. Thank you very much for listening, and you can find the blog post on my Forbes.com blog.
I'm Rob Arnott. I'm founding chairman of Research Affiliates. We're best known for our work in smart beta and asset allocation, with over 140 billion of assets managed worldwide using our investment strategies. We're unusual in the asset management arena, singularly focused on research and product innovation, not managing assets directly. We work with distribution partners to make ideas available to the broad marketplace. We deliver solutions in partnership with distribution powerhouses such as PIMCO, FTSE, SSGA, BlackRock, Legal & General, Invesco, and Nomura, just to name a few. These firms bring our ideas to their end clients through mutual funds, ETFs, separately managed accounts, and other vehicles. We're recognized as one of the pioneers of smart beta. Back in 2005, we introduced the Research Affiliates Fundamental Index, also known as RAFI, as an alternative to traditional market cap indexes. Fundamental Index weights companies based on the size of the business, not based on the popularity of the company, not based on how much the market value is, not based on how extravagantly expensive the company is. We rate companies based on measures like book value, cash flow, dividends, and sales. And importantly, that severs the link between the price of a stock and its weight in the portfolio. The Achilles heel of cap weighting is that it links the weight directly to the price. So if the price doubles, the weight in the portfolio also doubles. This means that you're inherently overweight all of the overvalued companies in the market and underweight all of the undervalued companies, even though you can't know which companies are which. RAFI offers a contrarian approach that underweights overvalued stocks and favors out of favor more appropriately valued stocks. Along with the fundamental index, we also offer single, multi-factor, and ESG-based indexes. We also do quite a bit of work in asset allocation, predominantly in our affiliation with PIMCO. To learn more about us and to sign up for our research insights, please feel free to check our website at researchaffiliates.com and rafi.com. As I'd done last year with Yes, It's a Bubble, I've been asked to read a follow-up piece we published 1 year later called Bubble, Bubble, Toil and Trouble. In April 2018, we published our most downloaded article ever. Yes, it's a bubble. So what? Our key purpose was not to make the observation, yes, it's a bubble, but to offer a formal definition of bubble, which is perhaps the first formal definition that can be used to identify a bubble in real time instead of years after the fact. A second point that we made was that bubble prices, asset prices far higher than those a valuation model can justify with plausible assumptions, can continue to soar higher and longer than many of us could imagine. As the saying goes, the market can remain irrational far longer than you can remain solvent. Indeed, in true bubbles, we should expect them to soar until they don't. Our third point was to illustrate how investors can use that definition to identify and avoid the trap of current bubbles and instead seek out anti-bubbles and assets that are likely undervalued. With the blessings of an admittedly short year of hindsight, how useful were our observations? Most turned out to be spot on. So where do we see bubbles today, and what should investors do? As Harry Markowitz has observed, the only free lunches in finance are diversification and long horizon mean reversion. We can bet on mean reversion in bubble assets, but we must never do so on a scale large enough that runaway speculation could ruin us. Our 2018 article offered a reasonable definition of the term bubble, which we can use in real time to identify bubbles as they form. We identify a bubble as having two characteristics. First, the asset or the asset class offers little chance of a positive risk premium relative to bonds or cash using a generally accepted valuation model with a plausible projection of expected cash flows. Second, the marginal buyer of the asset or asset class disregards valuation models, presumably buying based on a popular narrative and expecting to resell the asset to someone else at a higher future price, and as if the market will tell them when to sell. Our definition of anti-bubble, which attracted little attention in our 2018 article, but is equally important is the opposite. An anti-bubble is an asset or asset class that requires implausibly pessimistic assumptions in order to fail to deliver a solid risk premium. In an anti-bubble, the marginal seller disregards valuation models, which are indicating that the asset is undervalued. In this article, we also identify some anti-bubble opportunities. Note our use of the words plausible and implausible. The growth required to justify a stock's current price need only be implausible, not impossible. Certainly, categorizing an event or achievement as implausible requires reasoned judgment and a perspective with which some, likely many, market participants may disagree. A handful of the many high flyers during the tech bubble of 1999 to 2000 achieved their implausible growth expectations. Amazon comes to mind. This doesn't change the fact that only one of the 10 largest tech stocks of year-end 1999 has beat the S&P 500 index in the intervening 19 years. Amazon and Apple, both of which handily beat the S&P 500, were not in the top 10 list in 1999. Clearly, identifying bubbles in real time can add considerable value for the patient investor. Identifying a bubble, however, does not guarantee that the bubble will burst, although that outcome is highly likely, nor does it provide any insight into when it may burst. Defining a bubble requires applying reasoned judgment around unobservable variables. What constitutes a plausible projection of expected cash flows likely differs from one observer to the next, and identifying the motivations and beliefs behind the mass of investors' purchasing decisions generally requires careful assessment. Even so, the importance of a definition applicable in real time cannot be overstated. Too often, pundits identify bubbles much like the National Bureau of Economics Research identifies recessions, only in hindsight, typically years after the fact, which offers no actionable opportunity for investors in real time. Our scorecard since April 2018. Our 2018 article, we argued that bubbles were occurring in parts of the global technology, in Tesla, in Bitcoin, and other cryptocurrencies. Let's review what's happened with these assets over the intervening months. Technology stocks. Timing the collapse of a bubble is, of course, notoriously difficult. But in the fourth quarter of 2018, we believe we saw the first warning of a possible burst, with more drama likely to follow. We noted the rarity of seeing such a concentration of companies from one industry dominating the global market cap roster of companies. At that time, 7 of the 8 largest stocks in the world were tech companies: Alphabet, Apple, Microsoft, Facebook, Amazon, Tencent, and Alibaba. Since then, Apple, Amazon, and Microsoft have all crossed the 1 trillion market capitalization mark. It bears mention that none of these 3 stocks clearly meets our definition of a bubble. Each of these companies is a business with ample cash and cash flow, and each is priced at a level that would require aggressive but not implausible expectations of future growth in order to deliver a solid equity risk premium in a discounted cash flow model. Not much has changed in the last 15 months, but we could hardly be faulted for anticipating continued turnover in the top 10 list. Typically, only 2 or 3 of the top 10 retain that perch after a decade. The historical record shows that the global top dog, the stock with the greatest market capitalization, has outpaced the global capitalization weighted index over the next decade, only once and only barely in the last 30 years. And the average shortfall of 10.5% a year compounded for 10 years is hardly tiny. What client would have faith in a mutual fund manager who asserts that history suggests that my largest holding has a 95% chance of underperforming by double digits annually, but I'm happy to invest more in this company than in any other? Market cap index fund investors exhibit this type of faith. Whereas the bubble is most evident in the large cap technology stocks, market cap weighted indexes correspondingly rely on these pricey names to drive returns. The more concentrated these top names are within an index, the larger the bet on these holdings. Concentration of market weight in these top technology names is at a level not seen since the buildup of the dot-com bubble. The Russell 1000 now commits over 14% of its portfolio to the well-documented FanMag stocks, Facebook, Amazon, Netflix, Microsoft, Apple, and Google, a proportion that has nearly doubled since year-end 2014. The Russell 1000's 10.5% return over the first 9 months of 2018 was led by increasing enthusiasm for the continued record profit growth of the FanMag group. Facebook, with its well-documented stumbles, was a noteworthy exception. These 6 stocks were responsible for nearly 40% of the Russell 1000's return over this period, posting an average return of just over 40%. Notably, the list is not cherry-picked to be just the top contributors. It includes the impact of Facebook's negative performance. Even so, the return from these stocks is well above normal levels, although not as dramatic as the return earned by the technology stocks during the dot-com bubble in 1999. But in the fourth quarter of 2018, the FanMag stocks lost an average of 21%, recovering those losses for the most part in early 2019. Was the market downturn the beginning of a return to sanity, or did the recovery signify more good times ahead? It remains to be seen. Such rebounds are not uncommon as a bubble unwinds. For example, the NASDAQ plunged 36% from March 2000 until May 2000, only to gain back 35% by July 2000. Of course, this was a mere pause and final exit opportunity before the 58% drop between July 2000 and the October 2002 lows. The drop in the S&P 500 of over 6% in May 2019 was magnified by the behavior of the FanMag stocks, which were down nearly 15% for the month. The FanMag stock's much larger decline illustrates the sensitivity of share prices to bad news when a stock is priced to near perfection. In some cases, such as Apple, the May 2019 dip moved prices away from bubble levels. But this is far from true across the board. A correction is not a crash, and prices can easily recover. As J.P. Morgan, or was it John David Rockefeller, said, the markets will fluctuate and can make any short-term prognostication look foolish. Another bubble we explored a year ago was Bitcoin. After April 2018, Bitcoin also experienced a sell-off and an aggressive rebound, although more volatile and rapid than that of the tech stocks. According to CoinMarketCap.com, the universe of cryptocurrencies fell from a peak market capitalization of $828 billion in early January of 2018 to $125 billion at the end of the year, an 84% drop, and a loss in aggregate paper value of over $700 billion. This loss of wealth is roughly equivalent to the aggregate GDP of Switzerland, the world's 20th largest economy, and one that ironically boasts a notoriously safe haven currency. Bitcoin has now staged an amazing 187% recovery through the first half of 2019. Is this just volatility, or is it a true bubble? Based on our definition, plenty of bubble indications remain. If Bitcoin truly becomes an accepted currency, no valuation model for it exists other than what the public chooses to believe it's worth, much as the same as for the dollar or any other fiat currency. Similar to Dutch tulip bulbs in 1638, little evidence of fundamental value supports crypto's price beyond the speculation that they will become a well-accepted medium of exchange. Consistent with our definition of a bubble, cryptocurrencies hold little chance of offering a positive risk premium relative to bonds or cash based on a reasonable expectation of future cash flows, which are by definition zero. Predicting near-term price direction is a fool's errand, but any expectation of a higher price going forward rests solely on the hope of selling to a future buyer at a higher price. Tesla. In April 2018, we offered Tesla as an example of a single asset micro bubble because Tesla has little chance of delivering the heroic future cash flows needed to service its debt, let alone justify the valuation of its stock. Interestingly, although the company's valuation is based on explosive growth and profitability that's always just around the corner, that has been the case for 7 years, reflecting an ongoing battle between expectations and reality. Expectations were fueled by a series of dramatic announcements of new products, none of which bore the anticipated fruit. The introduction of solar tiles and the Powerwall on October 28, 2016. The Model 3 delivery event on July 28, 2017. The promise that Tesla would be producing 10,000 cars a week by the end of 2017 on August 2 of 2017. And the semi-truck and the Roadster 2 reveal on November 16 of 2017. These announcements by Elon Musk kept enthusiasm high despite the company's failure to produce any profits. Despite these setbacks, Tesla's share price was $332 at the start of the new year, but a terrible first quarter of 2019 was a cold shower of reality. Over the first 6 months of 2019, Tesla price fell 32% to $223. The share price first reached this level in January of 2016, so most investors since that time are likely underwater. The ability of dramatic presentations to support Tesla's share price is fading. Neither the Model Y reveal in March of 2019, nor the autonomous driving and robo-taxi presentation in April of 2019 were able to prevent further slides in the share price. The Tesla experience illustrates the large challenges in predicting the evolution of bubbles. Expectations can keep prices at bubble levels for years until suddenly the bubble asset loses its magic and the market outlook switches dramatically. For instance, Morgan Stanley, which placed a $379 target price on Tesla shares in October of 2017, recently slashed its worst-case scenarios for Tesla to $10 a share. On May 22, 2019, the Wall Street Journal described how Wall Street was losing faith in Tesla, stating there's a lot more sizzle than steak to the Tesla story. It turns out we were not wrong about Tesla just a few months early. Timing the top of a bubble is an exercise in futility. Of course, exceptional examples exist of individual companies that beat the odds. Amazon met our definition of a single asset microbubble in 2000, but has proved itself to be the rare company that exceeds the lofty expectations of the 1999 to 2000 tech bubble. According to our definition, a bubble is present when growth sufficient to justify an asset's current valuation level is implausible. Implausible is not impossible. There will always be counterexamples. Were there no examples investors could hang their hopes on, bubbles would be unlikely to get started in the first place. Actionable steps in today's market. Apart from providing a useful definition of a bubble and of an anti-bubble, perhaps the most important part of our 2018 article was our discussion of so what. Far from an apathetic disregard of the situation, we gave actionable advice on steps to prepare investor portfolios for the potential bursting of a bubble. These still apply. Our recommendation 15 months ago was to reduce exposure to bubble assets, avoid cap-weighted indexes, which inherently overweight bubble assets, seek exposure to anti-bubble assets or markets that are implausibly cheap, and invest in value-based smart beta strategies, especially in Europe and the emerging markets. Avoiding bubbles and markets. We've already addressed the current environment for cryptocurrencies. Despite today's lower prices, we see little to justify a floor of fundamental value. Our recommendation remains to avoid. We can say the same for Tesla. With that stock has come off its highs, its valuation remains at a point well above that justified by even optimistic expectations for future cash flows. And so, avoid. U.S. technology stocks remain a more nuanced cases. As we noted a year ago, Apple and Microsoft flunk our definition of a bubble. In order to justify current valuations using a discounted cash flow model or any other valuation model, An investor needs only make aggressive, not implausible assumptions. Additionally, the marginal buyer includes plenty of investors who rely on a valuation model as part of their decision process. The same cannot as easily be said for Tesla, Netflix, Tencent, or Twitter. The stocks of these companies all arguably qualify as being in bubble territory per our definition. Some even qualify as a zombie company, a company with EBIT, earnings before interest and taxes, less than its interest payments on its debt. A zombie company needs new capital just to pay the interest on its debt, let alone the contracted principal repayments. Others, like Amazon, might or might not qualify as bubble stocks. We could make a case either way. Even in a turbulent market, most of these tech stocks are trading at valuations nearly as rich as they have ever traded. The volatility in the fourth quarter of 2018 and in recent weeks should serve as a strong reminder of the risk inherent in any investment strategy. The assumptions of a strategy is based on must be right in order to derive long-term profit. Bubble level expectations require near perfect execution. Another consideration is that many of the new tech companies, notably Alphabet and Facebook, derive their revenues from advertising. The narrative these advertising budgets will not be cut in a downturn is untested and perhaps a very dangerous assumption. Advertising is almost always one of the deepest spending cuts in a slowdown or a recession. Is the rebound so far in 2019 a chance for investors to exit prior to a large drawdown, similar to the opportunity offered investors in the dot-com stocks in May of 2000? Of course, we don't have a crystal ball. We would recommend not betting on the momentum continuing, nor on trying to score a big win with a short position. Rather, we prefer to take the simple step of just avoiding the bubble assets we've identified. We interpret the market decline in May of 2019 not as the end of the story, but as another warning as to what can and likely will happen. With this in mind, investors also need to be wary of market cap-weighted indexes. Because these indexes tie their constituents' weights to market prices, they take on ever-increasing bets in overvalued companies and strategies. As bubble technology stocks have come to dominate the world's list of the largest companies, cap-weighted indexes are making de facto bets that these growth-oriented companies can increase their valuations in the face of a slowing economy. Investors can reduce their exposure in this space by turning to smart beta strategies, especially those with a value orientation that breaks the link between prices and portfolio weights. Find anti-bubble assets and markets. Although an anti-bubble in an individual stock is exceedingly rare, an anti-bubble in a sector or a market is more common than most observers might think. Consider the depths of the global financial crisis in 2007 to 2008. Could the value of any single bank have gone to zero, making any stock price too high? Yes. But could the economy survive without a financial sector? Not really. Going to zero for a sector is highly implausible. Did each bank that failed create an easier environment for the survivors to prosper, a clear runway for them to take off? Yes. Did margins improve for their survivors? Yes. Financial services and consumer discretionary stocks in early 2009 were an anti-bubble, and we said so at the time. We see a similar situation for value-based smart beta strategies outside the US, particularly in emerging markets. While emerging markets as a whole trade at much more attractive valuations than the US markets, value strategies within the emerging market space are poised to deliver an additional 2% to 4% performance advantage over their cap-weighted counterparts. A frothy top in the US market doesn't mean investors need to avoid equity beta altogether, but rather seek out more attractive alternatives to source that equity risk, especially in markets where valuations stack the odds in investors' favor. One particular area of emerging markets falls squarely into the anti-bubble camp. Unloved and shunned emerging market state-owned enterprises, often called SOEs. Many investors choose not to own them at any price. Yet many of these entities are earning substantial profits and are trading at levels that require implausible projections to not meet the future cash flows priced into their shares. Yes, there is a real risk of the state expropriating some of these cash flows. But if these SOEs wish to maintain continued access to the global capital markets, they need to continue to return some of the profits to external shareholders. The SOEs and governments that most support growing shareholder rights and the rule of law will be best able to expand their access to global markets. A representative index of SOEs is not available. Therefore, we made a list of the top 50 SOEs in the emerging markets and examined the valuation of that group. The top 50 are a concentrated portfolio with over 2/3 of the portfolio's weight by market capitalization in Chinese companies, over half in the financial sector, and nearly a quarter in energy. Even so, the value is compelling. These SOEs pay a weighted average dividend yield of 4.2%, offering a safety net along with a likely large risk premium. Compare those characteristics to the broad-based MSCI Emerging Markets Index, which includes all of the 50 SOEs as a subset, which has a dividend yield of 2.75%, a modest premium to the MSCI ACWI's 2.5% yield. This group of SOEs trades at a weighted average price-to-book ratio of 1.03. This is a 36% discount to the Emerging Markets Index price-to-book value of 1.61, and at a price-earnings ratio of 8.9, 34% lower than the 13.5 PE of the broader market. What would it take for one or more of these 50 SOEs to not deliver a substantial risk premium over the next 10 years? The enterprise would have to slash its dividends and stagnate or become materially cheaper. These are large, productive enterprises sitting at the center of strongly growing economies, and they currently represent real value. The risk is that the value stops flowing to overseas shareholders. Certainly not out of the question, but in our view, an implausible outcome. Within developed markets, we see the turmoil over Brexit potentially creating an anti-bubble opportunity in the UK shares, especially if a hard Brexit becomes the odds-on scenario. The MSCI UK index offers a dividend yield of 4.5%, even higher than the dividend yield of our basket of emerging markets SOE stocks. The market is pricing UK stocks at 13.8 times earnings, a full 25% discount to the MSCI World. UK share prices have been essentially flat since the 2016 referendum in which voters opted to leave the European Union. Brexit would need to destroy quite a bit of value in order to nullify this compelling risk premium. An overhang of uncertainty is keeping the discount in place. The capital markets hate uncertainty. A resolution in either direction would reduce the uncertainty and should encourage some capital flow back into the UK markets. Investors waiting for that clarity will miss the opportunity. In conclusion, consider how the juxtaposition of bubbles and anti-bubbles relates to so-called market myopia. Periodically, the financial press carries articles in which leading executives complain that the market focuses too acutely on short-term performance. Warren Buffett and Jamie Dimon have gone so far as to suggest that companies should stop providing quarterly guidance. What we're observing today for both bubble and anti-bubble assets is just the reverse. Entities such as SOEs with large quarter-to-quarter earnings and juicy cash flows are trading at deeply depressed valuations, while market participants are looking past negative cash flows and massive current losses coming from the Ubers of the world and are rewarding them with sky-high valuations. Could this be a case of market hyperopia? During the tech peak in 1965, when a concentrated list of a few dozen stocks soared to several times the market multiple, A wit quipped that these share prices appeared to discount not only the future but the hereafter. Isn't this exactly the case with bubble stocks? And with anti-bubble stocks, aren't the markets tacitly assuming permanent impairment? It takes remarkable hubris to think we can forecast a company's prospect beyond 2 or 3 years. If a company's share price only makes sense if its business soars or flounders for many years to come, we are discounting the hereafter. That is a bubble, and the converse, an anti-bubble. Neither is as hard to identify in real time as most investors think. At present, there are many interesting investment opportunities and sensibly priced asset classes. Notwithstanding the experience at the end of 2018, it's exceedingly rare for all risk assets to fall at the same time. As is so often the case, the promising investment opportunities are not the popular and beloved assets of today, but are the ugly ducklings, the unloved, feared, and even loathed assets. Thank you for your time.
Hi, this is Alec Lucas. I work for Morningstar Manager Research Services, and I'm going to read a paper entitled A New Perspective on Geographical Diversification, Revenue Exposure by Region. It was first published in February 2019 and is a collaborative effort on the part of Morningstar Manager Research Analysts in the United States, Europe, and Australia. Domicile has long been an investor's only way of geographically diversifying a portfolio. In certain instances, this can give a misleading interpretation of the actual diversity of a portfolio. As the world has grown, so has the reach of large multinational companies. Now, where a company is headquartered can have little bearing on where its underlying revenues come from. The tobacco company Philip Morris International, for example, has long been one of the largest stocks in the S&P 500 index without ever having any U.S. revenues. Similarly, the pharmaceuticals firm GlaxoSmithKline is a large fixture in Britain's FTSE 100 index, but gets minimal revenue from the United Kingdom. While it might seem obvious that prominent multinationals like Philip Morris and GlaxoSmithKline have global revenue streams, it isn't always clear where less well-known companies make money. Consider Millicom International Cellular. MSCI regards it as a Swedish business, whereas Morningstar assigns it a U.S. domicile. Neither domicile does justice to the economic drivers behind Millicom International Cellular's current business, however. It is focused on Latin America and Africa. As of fiscal 2017, Millicom International Cellular got more than 85% of its total revenue from Colombia, Paraguay, Bolivia, El Salvador, and Costa Rica, with most of the rest coming from Tanzania and Chad. Viewing such companies through the lens of revenue offers a significant advantage over domicile. Looking at revenue exposure by region alongside domicile highlights differences between these two approaches to geographical diversification. What stands out most is the importance of China and the United States to the global economy. Consider the MSCI All-Country World Index's domicile and revenue-based exposures by region and country, respectively, as of September 2018. Each region's revenue exposure is within about 3 percentage points of its domicile-based weighting, except for Asia Emerging in the United States. Asia Emerging's 9.4 percentage point increase is driven largely by China, which has a 3.5% domicile-based weighting in the MSCI All-Country World Index, but a 10.6% revenue-based weighting, a threefold increase. The United States' relative importance, by contrast, decreases. At 41.9%, its revenue-based weighting is 13.3 percentage points less than its domicile-based weighting. Even if the United States' relative stature diminishes in the shift to revenue from domicile, its absolute importance remains paramount. Comparing the United States, China, and Japan, the three biggest countries from the standpoint of revenue, the United States' 41.9% share of the MSCI All-Country World Index's revenue is nearly 4 times that of China's 10.6% and nearly 6 times that of Japan's 7.2%. Moreover, home country bias is especially pronounced for U.S. investors. Only Australia's S&P ASX 200 index rivals the United States S&P 500 index for the percentage of revenue it receives from its home country. 57.9% versus 62%. At the other end of the spectrum, France's Euronext Paris CAC 40 index garners just 17.5% of revenue from its home country. To put that figure in context, the MSCI All Country World ex-US Index receives 16.8% of its revenue from the United States, even though that benchmark excludes US domiciled companies. US investors face the challenge of revenue-based home country bias even to some extent in the international portion of their portfolios, whereas European and perhaps most other investors, save Australians, face the challenge of rooting the domestic portion of their portfolios in the revenues generated from their home countries. Some investors, of course, would not see either condition as a problem. U.S. investors, for example, might wish to preserve home country bias within their portfolios because of the potential impact of tariffs, whereas French investors might be content with modest home country revenue exposure because they prefer the prospects of companies doing business elsewhere. Either way, one can decrease or increase home country revenue exposure by paying heed to market cap and style. Consider the revenue exposure by region for domestic benchmarks with differing market cap orientations for the United States, the United Kingdom, Germany, and Australia. Each tells a similar story. As the average market cap increases, the percentage of revenue from one's home country decreases, and the percentage of revenue deriving from other regions generally increases, a pattern that is especially pronounced in the U.S. benchmark's exposures. Investors who want to magnify home country exposure should tilt their portfolios towards small caps. Conversely, investors seeking greater revenue diversity within their portfolios can tilt them toward mega cap stocks. Granted, with more than half of the S&P 100 index's revenue still deriving from the United States, tilting toward mega cap stocks won't remove revenue-based home country bias for U.S. investors. Attending to style, however, offers another lever that investors can pull. Consider a mapping of the growth and value versions of the Russell 1000, Russell Midcap, and Russell 2000 indexes to the 9 grids of the Morningstar Style Box, including the percentage of each benchmark's U.S. revenue. The growth version of each index has a lower weighting to U.S. revenues than its value counterpart. And in general, the tilt away from the United States and toward other regions once again becomes more pronounced as one moves up the market cap ladder. So, for example, the Russell 1000 Growth Index gets 59.6% of its revenues from the United States versus 79.7% of its revenues from the United States for the Russell 2000 Growth Index. By contrast, the Russell 2000 Small Cap Index and the value version gets 82.8% of its revenues from the United States. So as you go down the market cap ladder and towards value, you get more exposure to your home country, in this case, the United States. Even for investors without access to Morningstar revenue by region data, these insights about market cap and style provide a number of ways to increase international revenue diversification within a portfolio. One is to build a portfolio oriented towards mega cap growth stocks, as these companies have the business models and resources to pursue opportunities irrespective of geography. In contrast, another option is to build a diversified global portfolio oriented towards small cap value stocks, because these companies tend to have businesses that receive most of their revenues from their home countries. Investors can also combine these two contrasting approaches. The third option results in a portfolio characterized by market cap, style, and geographic diversity, whether measured by domicile or revenue source. Investors mulling which option to choose should bear in mind the kind of businesses associated with mega cap growth stocks versus small cap value stocks. Consider the S&P 500's aggregated U.S. revenue exposure for each of the 24 global industry classification standards industry groups. Those industry groups with the lowest U.S. revenue percentage tend to have a heavier weighting in growth-oriented benchmarks and funds, while those with the highest U.S. revenue percentage tend to have a heavier weighting in value-oriented benchmarks and funds. The financial sector, for example, is often the biggest weighting in value indexes, and all three of its industry groups, banks, diversified financials, and insurance, receive between 70% and 85% of their revenue from the United States. These characteristics for home country revenue exposure generally hold for all the markets we examined. Yet at the individual company level, outliers exist. Per Morningstar data as of September 2018, Citigroup bucked the trend within banking by receiving less than half of its revenue from the United States and as much as a fifth from Japan. The semiconductor company Analog Devices received 39.1% of its revenue from the United States, nearly 3 times its industry group average. Even as drilling down to the individual company level provides insight into the revenue variation within industries, it also shows the data isn't as standardized as one might wish. Indeed, sometimes differences start with the definition of revenue itself. When comparing the fiscal 2017 annual reports of Analog Devices and Skyworks Solutions, one finds that these companies on the surface seem to differ dramatically in the percentage of revenue received from China, with Analog Devices garnering 17% and Skyworks 82.7%. Yet Analog Devices defined revenue in terms of the primary end customer location for its products, whereas Skyworks revenues did not necessarily correlate to end market demand by region. In fact, Skyworks even went to the trouble of highlighting that its China revenues included sales of products to a company that is not headquartered in China, but that manufactures its products in China for sale to consumers throughout the world. That company was almost certainly Apple, and had Skyworks defined its revenue in terms of end customer location, its China revenue would have dropped significantly. In fiscal 2018, Skyworks redefined its geographic-based revenue definition for that year and for the 2 previous ones, from country of destination to the site of the original equipment manufacturer's headquarters, or end customer location. That cut Skyworks' fiscal 2017 China revenues to 27.9%. A nearly 55 percentage point drop from under the prior definition. To the extent that this change represents a trend toward data standardization, it is an encouraging sign. Yet the Skyworks example also highlights the potential challenges of assessing one's company's revenue exposures, much less a portfolio of companies. It is therefore useful to take a step back and outline how Morningstar's new revenue exposure by region data point comes together. This lens for public companies is nearly comprehensive in scope. Morningstar's library of annual and semi-annual filings includes stocks trading on major exchanges in North America, Europe, Australia, and New Zealand, as well as firms whose market capitalizations exceed USD 100 million. The resulting database covers the vast majority of the world's equity market capitalization. In content, though, the revenue exposure by region lens for portfolios is necessarily directional. That is, because revenue disclosures vary from company to company in the regional classifications of their operating segments, and even within the same company, geographical-based segments can be intermingled with functional segments spanning multiple geographies. For the operating segments of Apple, PepsiCo, and Coca-Cola, consider Greater China as an example of how these companies' regional classifications differ. Apple reports separate revenue results for Greater China, composed of China, Hong Kong, and Taiwan. PepsiCo includes Greater China in Asia, and within the same operating segment combines Asia's results with those from the Middle East and North Africa. Coca-Cola's Asia-Pacific region isn't as broad, but still groups Greater China together with countries as disparate as Australia and India. Matters are more complicated still, as Coca-Cola's bottling investments business, which accounted for 29.8% of firm-wide revenue in fiscal 2017, reports the results of bottling operations regardless of the geographic location of the bottler, some of which are in China. Thankfully, not every company makes it so difficult to assess the geographical sources of its revenue. Nestle stands out in this regard. In fiscal 2017, it reported country-level sales for 16 of its principal markets, accounting for 73% of total firm-wide sales. Companies also sometimes disclose revenue figures for geographies independent of or in addition to their regional operating segment classifications. Coca-Cola, for instance, transcends its North America and other geographical-based operating segments by reporting net operating revenues from the United States alone and its international operations altogether. Morningstar's revenue exposure by region data uses country-specific numbers and company filings whenever available. The present state of financial disclosures, however, requires estimates, often to standardize the geographical data. Morningstar generates these estimates by dissecting companies' regional classifications into their component countries and using gross domestic product figures to approximate the proportion of sales allotted to each. Those country estimates are then asset weighted for each security within a portfolio and rolled up to provide portfolio-level revenue exposure calculations for 13 regions, comprising more than 240 constituent countries. Revenue exposure by region data provides an important perspective to incorporate in selecting strategies to build one's portfolio, whether one seeks revenue diversity through mega-cap growth funds or prefers a global small value approach. The revenue exposure by region lens can also help investors assess whether a fund is adhering to its mandate when domicile-based measures call that into question. Considering both revenue source and domicile provides investors with a more complete picture of what they own. Companies' geographic sources of revenues, though, matter most in the aftermath of surprising political or macroeconomic events. That is what a comparison between revenue-weighted benchmarks and their market cap-weighted counterparts suggests following the United States November 2016 presidential election and following the United Kingdom's June 2016 vote to leave the European Union. These revenue-weighted benchmarks were constructed using the Morningstar US Large Mid and Morningstar UK Large Mid indexes. Constituents without any domestic revenue, such as Philip Morris International or Randgold Resources, were eliminated, and each stock was then weighted by multiplying its market cap float with its domestic revenue percentage. The resulting revenue-weighted benchmarks for both countries had substantially higher weightings in the financial sector and to a lesser extent in utilities and real estate. They differed, though, in where they were the lightest relative to their market cap-weighted counterparts, with the U.S. bogey's tech weighting dropping the most and the U.K. index's materials weighting coming down the most. Each revenue-weighted benchmark behaved as one might have expected in response to a major domestic shock. The winning U.S. presidential candidate's nationalistic rhetoric contributed to many companies with predominantly U.S. revenues, especially financials, rallying in the election's immediate aftermath. Between November 8, 2016, the election day, and December 1, 2016, the revenue-weighted version of the Morningstar U.S. Large Mid Index gained 4.3%, outperforming by 1.2 percentage points its market cap-weighted counterpart. Granted, not every industry group with high U.S. revenues fared well. Utilities and real estate companies lagged, likely in part because of concerns about rising interest rates. Yet during this period, small caps outperformed mid caps, which outperformed large caps, and value beat growth. Exactly what one would expect given that home country bias increases in the move down the market cap ladder and toward value. Outperformance of U.S. revenue-heavy stocks proved to be modest and short-lived, but the United Kingdom's June 23, 2016 vote to leave the European Union had a more dramatic and lasting impact. Fear concerning the negative economic consequences of this decision was a major impetus in the subsequent underperformance of the revenue-weighted version of the Morningstar UK Large Mid Index. From the day after the Brexit vote through October 2018, when our data ends, the revenue-weighted benchmark's 2.8% cumulative gain in Great British pounds trailed the Morningstar UK Large Mid Index by a whopping 20.2 percentage points. The month of the Brexit vote, June 2016, stood out, as during it the revenue-weighted index lost 9.5 percentage points more in Great British pounds than its market cap-weighted counterpart. That's a huge difference between two indexes that, despite their different weighting methodologies, share a 0.9 correlation, 98% similarity of holdings, and less than 50% active share. In debuting its revenue exposure by region capability, Morningstar has given investors an important tool for gauging geographic exposures within their portfolios that may not be readily apparent from looking at domicile alone. A company's country of domicile will continue to be important, but domicile-based measures cannot capture the geographic diversity inherent in most companies' revenue streams, much less a portfolio of those companies. And in certain cases, domicile-based measures prove misleading. The revenue exposure by region lens offers a major step forward. Morningstar's revenue exposure by region capability gives investors the ability to determine the global makeup of their equity portfolios. Those seeking revenue diversity in their portfolios can tilt toward strategies with diverse revenue mixes or add options to address underexposure. Investors can also choose to tilt toward or away from a region or country for macroeconomic reasons, such as a debilitating trade war or Brexit-like scenario. In the end, use of this tool allows investors to be more aware of the geographical risks they are taking.
Hi, this is Martin Tarlie. I'm a portfolio manager and research analyst at Grantham Mayo Van Otterloo, otherwise known as GMO. GMO is an investment management firm located in Boston. I'm going to read a paper entitled, "Is the U.S. Stock Market Bubble Bursting? A New Model Suggests Yes." But before I get started, I'd like to provide a little context. This paper deals with a quantitative model of stock market bubbles. I wrote the paper in early 2019. At that time, valuations were high, but because there was not a great deal of euphoria in the markets, Jeremy Grantham, the G in GMO, and a practitioner who has spent much of his career studying bubbles of all varieties, including stock market bubbles, did not think that the U.S. stock market was in a bubble. However, over the past few months, based on recent price action and stories of euphoria, Jeremy now does believe that the U.S. stock market is a bubble. So one way to view this paper that I'm going to read to you is that in typical GMO fashion, it was early. So now imagine yourself reading this paper in early 2019, and let's get started. In the fourth quarter of 2018, the S&P 500 fell almost 14%. This large price drop occurred in spite of a strong fundamental backdrop. Earnings per share for 2018, much of it already locked in, is expected to be about $140, a 28% increase over 2017. And expectations for 2019 are for EPS of about $156. A 12% annual increase. With fundamentals so good, what explains the recent price action? A new model, the bubble model, explains the dichotomy between price action and fundamentals by suggesting that a bubble in the U.S. stock market started inflating in early 2017 and continued to inflate through the third quarter of 2018. In the fourth quarter, however, indications were that the bubble had started to deflate. And when bubbles deflate, they generally do so with a volatility bang. In this new model, bubbles are prone to form when times are good and expected to get even better. Good times now and even better times ahead are reflected in high valuations and solid fundamentals that continue to improve. Improving fundamentals lead to positive changes in sentiment, and these positive changes in sentiment fuel the bubble. However, sentiment cannot increase forever. When changes in sentiment, not level, inevitably turns negative as hopes of even better times ahead are dashed, there is nothing left to fuel the bubble. In the context of market action over the past quarter, that would be the fourth quarter of 2018, expectations of decelerating earnings growth, albeit still positive, reflect a negative change in sentiment. Furthermore, between August and December of 2018, estimated EPS for 2019 fell from $163.51 to $156.28, a decline of more than 4%. These earnings changes could reflect negative changes in sentiment, but other concerns, such as tightening by the Federal Reserve and trade tensions with China, can also cause negative changes in sentiment. And it is negative changes in sentiment, defined broadly, that can catalyze the pop. While there are indications that the bubble started to deflate in the fourth quarter of 2018, and the magnitude of both price action and the change in the quantitative measure of euphoria that defines the bubble model suggests that the odds are now tilted in favor of the view that this is the beginning of the end of the bubble. We would be well advised to remember Yogi Berra's counsel that, quote, "it ain't over till it's over," end quote. Past bubbles do exhibit head fakes, in which bubble deflation is interrupted by a secondary growth event. For example, in the third quarter of 1998, the time of the LTCM crisis, the bubble model suggested the bursting of the bubble that had started inflating in early 1997. However, the 1998 reading was a head fake, and the bubble continued to grow for another 18 months before finally popping in early 2000. To adopt the view that the price action over the last quarter, again, the last quarter being the last quarter of 2018, is that of a bursting bubble, one first needs to believe that the market was a bubble in the first place. The claim that a stock market bubble inflated over the past few years is controversial, even here at GMO. I build the case by first introducing a quantitative definition of euphoria, and then view both the long history of U.S. stock market valuation and the events of the past 3 years through this lens. The challenge of actually defining a stock market bubble. To appreciate the challenge of actually defining a bubble, we don't have to go far. In spite of the fact that recent valuations, as shown in Exhibit 1, match the peak of 1929 and are only surpassed by the dizzying heights of the dot-com era of the late 1990s, keen market observers, Jeremy Grantham included, were hesitant to call the market of 2017 and 18 a bubble. The reason? A distinct lack of euphoria. While there were some signs of highly speculative behavior in the form of the stunning rise in the price of Bitcoin, or activity around big data and artificial intelligence, newspapers were not filled with stories of barbers or shoe shiners turned stockbrokers. So while one condition for a bubble was satisfied, high valuation, the other condition, euphoria, was arguably absent. Now, bubbles have both quantitative and anecdotal characteristics. Jeremy Grantham's preferred quantitative measure, which he has written about for decades, defines a bubble as a market trading at 2 standard deviations above the trend. But bubbles are not only about high prices, they are also about animal spirits, captured in stories of euphoria. Economic historians have extensively documented these behavioral anecdotes for many bubbles over centuries. Speculators, imbued with animal spirits and driven by fear of missing out and dreams of becoming rich, follow the herd and increase prices with increasing fervor. The quantitative and anecdotal elements of a bubble are, by their very nature, very different. It can be challenging to get a clear-eyed view, especially in real time without the benefit of 20/20 hindsight. Anecdotal elements are inherently subjective, and the challenge is further compounded by the fact that prices can stay high for extended periods of time, breeding confusion and uncertainty. The bubble model, which focuses on the dynamics of valuation, captures both the quantitative and anecdotal euphoric elements of a bubble. Euphoria manifests as explosive dynamics, expressed quantitatively as a negative mean reversion speed. Because the model is quantitative, it does not suffer from the subjective uncertainties inherent in anecdotal stories. While most of the time valuation is mean reverting, on rare occasions valuation is temporarily explosive or mean averting. This mean aversion goes hand in hand with expensive valuation and is the defining characteristic of a bubble. Mean aversion or explosive dynamics arises when speculators dominate the market. Speculators are subject to fads and fashion and have a tendency to follow the herd. Their demand for stocks is ephemeral. Fundamental investors, on the other hand, assess value based on fundamentals and expected return considerations. Their demand for stocks is relatively stable. To the extent that fundamental investors dominate the market, fundamental value provides an anchor around which market prices vary. This is standard mean reversion. However, when speculators dominate, in other words, the percentage change in speculative value exceeds that of fundamental value, then price tends to move away from fundamental value because the deviations of price from fundamental value get relatively bigger. This is mean aversion. And in the paper, there's a sidebar that illustrates the mathematics behind that speculative value and fundamental value. So now, what about the historical evidence of mean aversion? The question of whether or not the stock market displays mean averting behavior is a statistical one. A positive mean reversion speed means that price reverts to fundamental value. In other words, mean reversion holds. However, a negative mean reversion speed means that price moves away from fundamental value and mean aversion, not mean reversion, holds. We can measure the mean reversion speed using standard econometric techniques. If the mean reversion speed is in fact constant, the estimate would show little to no variation apart from measurement error. We find empirically that the mean reversion speed does indeed vary over time. And not only does the mean reversion speed change through time, but there are times, though rare, when the mean reversion speed becomes negative. These negative mean reversion speeds are a quantitative measure of euphoria and represent periods of explosive dynamics or mean aversion. Exhibit 2 plots the empirical estimate of the mean reversion speed for the U.S. stock market from 1881 through 2018. Because the vertical axis is flipped, points below the zero line correspond to positive mean reversion speeds. These are periods of mean reversion. We see that, on average, the mean reversion speed is positive. There's a horizontal dashed line. So that most of the time, mean reversion holds. Between 1881 and now, there are only 5 periods of explosive dynamics. Number 1, the late 1910s. Number 2, 1929. Number 3, the early 1980s. Number 4, the late 1990s. And number 5, 2017 to 2018. The first 4 periods are well known to market historians, while the 5th period, which begins in 2017, is still playing out. The late 1910s is the period of the Forgotten Depression, an area of deflationary pressures and a depression economy. The 1929 bubble marks the end of the Roaring Twenties and the beginning of the Depression era of the 1930s. The early 1980s mark the end of the stagflation of the 1970s and the beginning of the almost 20-year bull market that culminated with the bubble of the late 1990s. The 5 periods of explosive dynamics are highlighted by the solid red circles in Exhibit 2. Also highlighted in the dashed red circles are the periods of stronger than average mean reversion that follow each period of mean aversion. Note, in particular, the dramatic move from the 3rd quarter to the 4th quarter of 2018. While the conditions in 1929 and the late 1990s are consistent with the bubble, high valuation and mean aversion, or explosive dynamics, the late 1910s and the early 1980s are characterized by low valuation and explosive dynamics. In these periods, mean aversion means that prices are low relative to fundamental value and expected to go even lower. Rather than a bubble, these periods actually define an anti-bubble, sometimes also referred to as a negative bubble. In an anti-bubble, the psychology is a dysphoric psychology rather than a euphoric psychology. The anatomy of 2017 and 2018. The 5th period of explosive dynamics, shown as a close-up in Exhibit 3, begins in 2017 and extends into late 2018. The mean aversion from early 2017 through the third quarter of 2018 is a quantitative measure of euphoria and suggests that over this period, a bubble is inflating in the US stock market, even though this period lacks the conventional anecdotes of euphoria, such as barbers and shoe shiners turned stockbrokers. And while such anecdotes appear lacking, the optimism and the enthusiasm surrounding big data, artificial intelligence, and Bitcoin, among other technological advances, are typical of the bubble-like animal spirits. The data point for the fourth quarter of 2018 shows a dramatic change in the mean aversion speed, from an explosive mean averting phase to a strongly mean reverting phase. The scale and duration of this move is consistent with the moves associated with the bursting of the 1929 and 1999 bubbles and the reflation of the anti-bubbles of the late 1910s and the early 1980s. One reason to take the bubble model seriously is that both the bubbles and anti-bubbles are rare. Since the late 1800s, we count only 5 episodes, including now. And 4 of these 5 are well known to market historians. It is likely that future market historians will learn to know the current episode as well. Another reason to take this model seriously is that it is consistent with 2 recent market observations made by Jeremy Grantham, independent of the model. First, Jeremy writes in the third quarter of 2016 quarterly letter about slowing mean reversion. The declining mean reversion speed in 2016, as shown in Exhibit 3, is consistent with this view. Next, in early 2018, Jeremy writes about a market melt-up and the evolution of his thinking with respect to the importance of price acceleration. Both the market melt-up and the importance of price acceleration are consistent with the mean reversion speed turning negative in 2017. So what can we expect when a bubble bursts? When a bubble bursts or an anti-bubble reflates, mean reversion comes back with a vengeance. We can see this effect in Exhibit 2, where, as highlighted in the dashed red circles, following periods of mean aversion, mean reversion is stronger than average. Understanding this effect relies on insight from the model about a mechanism for the creation and destruction of both the bubbles and anti-bubbles. The insight comes from analysis of the time series in Exhibit 2, and it reveals that periods of negative mean reversion are actually driven by the combination of positive change in sentiment and high valuation. The dependence on the combination of valuation and change in sentiment means that when valuation is extreme, relatively small changes in sentiment are amplified by the extended valuation and can produce large changes in price. Simply put, the bubbles are prone to form when times are good, high valuations, and expected to get even better, positive expected change in sentiment. The bubbles burst when hopes of even better times ahead are dashed. When these hopes are dashed, the positive change in sentiment turns negative. It is this flipping of the change in sentiment, not the level of sentiment, that actually drives the system back to a strongly mean reverting phase. And because the change in sentiment will at some point flip sign, after all, sentiment cannot keep expanding forever, the bubble is guaranteed to pop. Another way to visualize stronger than average mean reversion following periods of explosive dynamics is to plot the time series of valuation and mean reversion speed on the same graph. Exhibit 4 plots the mean reversion speed from Exhibit 2 on the vertical axis and valuation from Exhibit 1 on the horizontal axis. The bubbles are points in the upper right-hand corner, and anti-bubbles are points in the upper left-hand corner. Various bubble and anti-bubble dates are labeled, together with arrows that connect these dates with various points in the future. From this correspondence, we see that the mean reversion speed changes by a large magnitude over a short period of time, and these changes correspond to a rapid transition from mean aversion back to stronger than average mean reversion. Prior to the fourth quarter of 2018, the most extreme change in the mean reversion speed is the one from the third to the fourth quarters of 1929. Here, the mean reversion speed goes from slightly negative to strongly positive over the period of 3 months. However, the change in the mean reversion speed from the third to the fourth quarters of 2018 eclipses that of 1929, highlighting just how dramatic the last few months have been. The magnitude of this move also tilts the odds in favor of the view that we may currently be experiencing the initial stages of the bursting of the bubble of 2017 and 2018. Finally, a direct consequence of stronger than average mean reversion is that volatility in the post-bubble period is higher than average. This is simply because stronger than average mean reversion means, by definition, that the magnitude of valuation changes and therefore returns are larger than average. So what do we learn? The bubble model teaches us that bubbles form when times are good, high valuation, and expected to get even better, changes in sentiment are positive. Bubbles burst when changes in sentiment, not level, turn negative. This dynamic helps us understand how it is that during the fourth quarter of 2018, the market fell, even though fundamentals, both past and expected, looked solid. While as of December 2018, expected EPS growth for 2019 is 12%. This is substantially below the 28% growth of 2018. Furthermore, since August 2018, estimated EPS for 2019 has been revised downward by more than 4%. These changes, together with concerns about Federal Reserve tightening and trade tensions with China, point to negative changes in sentiment, a catalyst for popping a bubble. The key role played by changes in sentiment also highlights why it is so difficult to time a bubble. While the benefit of successfully riding a bubble and exiting in time is obvious, there are two reasons why this is a challenge. First, when the bubble pops, the reversal tends to be wicked, which is to say that mean reversion comes back with a vengeance. Mistiming can therefore be very costly. And second, the odds of mistiming are high because the catalyst for the pop is a change in sentiment. It is not the level in sentiment that we need to actually predict, but rather the change, which is much more difficult. There is another subtle but important point. I have been deliberately vague about what sentiment means. In Tarlie et al. 2018, which is the academic paper which this white paper is built on, the catalyst for both the bubble formation and the bubble destruction is expected change in profitability. But more broadly, we expect that change in sentiment is the catalyst, which is to say that there are myriad factors that can ignite animal spirits as the bubble forms, and then snuff them out as hopes for even better times ahead are dashed. Effectively, this vague definition reflects model risk. So even though we have a model that helps us understand how the bubbles are created and destroyed, unfortunately, it does not help us predict the timing of their demise. It does, however, provide us insight into why timing is so challenging. Our advice when the bubble is inflating is to avoid the siren song of buying into rising prices, thus avoiding the bubble altogether. While career risk can make this course of action very difficult, hence actually giving further life to the bubble, of course, we believe that the challenge of successfully timing the exit is such that bearing the career risk is the wiser and more prudent course for those with a sufficiently long time horizon. Currently, we are faced with a volatile market that through the end of 2018 at least, is down in double digits from the September 2018 peak. The volatility is consistent with a bubble bursting, though we caution that it is possible that the fourth quarter move in the mean reversion speed could be a head fake. While the dramatic nature of the move in the mean reversion speed to such strong mean reversion suggests that the odds are tilted toward this being the beginning of the end of the bubble of 2017-2018, we cannot rule out reflation of the bubble, analogous to the event of late 1998 through 2000. Given that valuation is still high, our advice, consistent with our portfolio positions, is to continue to own as little U.S. equity as career risk allows.
Hi, I'm Tyler. I'm a mechanical engineer, investing researcher, Excel nerd, and the author of Portfolio Charts, a website dedicated to studying the history and mechanics of all types of asset allocations. As you might imagine from a site called Portfolio Charts, I normally make heavy use of images and diagrams to explain complicated topics. This article is no exception. I'm going to do my best to paint a verbal picture, but if you're a visual thinker like me, go to portfoliocharts.com/convexity. That will take you to a page with number charts that you can study while following along. High profits at low rates, the benefits of bond convexity. In the world of investing, it seems most people's energy is focused squarely on stocks. Massive amounts of research goes into stock investing every day, and even casual investors have an incredible amount of information at their fingertips. Combine that wealth of data with a long-term growth pattern in the stock market since 2009, which means anyone who's been in the market less than 10 years has no recollection of a single meaningful bear market, and stocks are so ingrained in our collective investing consciousness that many people don't give other assets a second thought. As a result, while bonds were once staples of any self-respecting asset allocation, lots of investors just aren't into them like they used to be. Some of it is definitely recency bias, and I think another factor is that many people don't truly understand how bonds work. But I'll concede that the bond market is also different than what it was more than a decade ago, and I can understand why people might think twice about relying too much on historical data. After all, bonds sound like awesome choices when they pay 10% interest, but consistent declining rates over time surely boosted any back-tested numbers while depressing yields today to something a lot less desirable. So it's no surprise that I see questions along this line all the time. Quote, with record low interest rates today that are even negative in some situations, what's the point of having bonds in a portfolio at all? Unquote. That's a very good question. The full answer is complicated and includes some advanced finance mechanics that fly under the radar even for very experienced investors. But explaining complicated concepts is kind of my thing, so let's talk about a little thing called bond convexity. To do this topic justice requires covering a lot of ground, and I encourage you to read the whole thing. But to give you a sneak peek of where it's all going, here's what you can expect to learn. 1. How bonds make money. 2. The effect of convexity on bond returns. And 3. How to apply bond convexity to your own portfolio. Sound interesting? Let's get started. How bonds make money. Before we jump in the deep end, I think it helps to first talk about how a bond works. A bond is basically a loan that you provide for a fixed amount of time, called the maturity, in exchange for regular interest payments, called the coupon payment, along the way. Interest payments are something almost everyone is familiar with, and although the repayment of principal works differently in a bond than in a mortgage or student loan, paying and receiving interest on a loan is something we can all relate to. And the money we receive from interest payments on a bond is pretty simple. Figure 1 shows bond profit due to the coupon payment. The x-axis is the annual interest rate, and the y-axis is the return after 1 year. The relationship between the two is a straight line starting at 0 and sloping up to the right. Here you could see the 1-year return on a new bond held for 1 year. If the interest rate is 10%, the money received is 10% of the initial bond value. And if the interest rate is 0%, the money received is 0%. Things get a little more complicated if you talk about different definitions of overall profit or yield based on how long the bond is held, but for now let's keep it simple and think about new issues. Stare at that chart long enough and you'll eventually notice a problem that bothers a lot of potential bond investors. Why on earth would someone lend money at very low interest when there are higher returning options available? In fact, in some countries it's not uncommon to see bonds offered with negative interest where you pay the government to hold your money. There are a few reasons that might make sense, including the relative safety of other investments, but major institutional investors continue to buy bonds in huge volumes and they have way more options than your average investor. That seemingly irrational behavior gives us a clue that something else is going on. That something else is the idea of capital appreciation. Think of a 30-year bond with a 10% interest rate as a contract where someone has agreed to pay you $1,000 a year on your $10,000 loan for the next 30 years. You can choose to collect those payments for a full 30 years, or you can choose to sell that contract to another investor. Because interest rates for new bonds change all the time based on the prevailing market conditions, the value of your fixed contract changes along with them. That change in underlying market value for your bond is called capital appreciation, and it's the second way bonds make money. Your bond is worth more or less than you paid for it, and if you're lucky, you can sell it for a profit. The thing that drives the capital appreciation of the bond is the difference between the interest rate of your bond and the prevailing interest rates of a similar bond on the open market. When market rates fall, your bond with a high coupon is more valuable. And when rates rise, your bond with a low coupon is less valuable. So to track the value of your bond, you simply have to track interest rates over time. In order to illustrate how much a 1% move in interest rates affects the value of a bond, the financial industry reports a measure called duration. I won't bore you with all the math that goes into it, but I'll give you an example of how to use it. Looking up the home page for the Intermediate Term Treasury Fund, IEF, the effective duration as of today is about 7.4 years. That means that if interest rate changes by 1%, the value of the bond is expected to change by 7.4%. We'll study that expectation in more depth in just a moment, but for now think about how that expected change in value affects how you evaluate the bond. So to quickly recap, bonds make money in two ways: interest payments and capital appreciation. That explains how bonds can make money even with negative interest rates. But it's completely understandable that many bond investors will look at the combined interest rate and duration of a bond and assume diminishing returns as rates continue to fall. At some point, it just doesn't sound worth it. The effect of convexity on bond returns. Still with me? I realize that's a lot of new info for young investors to process, and I also understand that it may seem a bit elementary for experts already well educated about bonds. All of that background is important to paint the big picture for the next point that I wager may surprise both sets of investors. The assumption of diminishing returns with falling rates is wrong. Like really wrong. What if I told you that a theoretical 30-year bond with a negative interest rate experiences double the profit of one with a 10% interest rate, even if the change of rates is an identical negative 1%? It's absolutely true, and it's due to something called bond convexity. Bond convexity basically means that the sensitivity of a bond to interest rate changes is not constant. It's also not linearly related to rates. In fact, it accelerates as rates drop, and the amount of acceleration depends on how much time is left on the bond. The duration listed in the fund description is not wrong by any means, but like glancing at the speedometer while your car accelerates down the highway, it's simply a snapshot of an ever-moving target that follows a much more complex set of mathematical rules than you realize. To understand bond convexity, let's use the same 1% rate change sensitivity measured by duration, but map the real-world results over every interest rate for a variety of different bond maturities. When looking at this chart, keep in mind that this is not the results of a backtest. It's a fundamental equation for how bonds work. Figure 2 shows the change in bond value due to a 1% decrease in interest rates. The x-axis is the interest rate at the beginning of the year, and the y-axis is the capital appreciation at the end of the year. The multiple lines are color-coded by the term to maturity of the bond, and the resulting chart looks like a curving rainbow with a tight spread at high rates and a wide spread at low rates. The chart is packing a lot of data, so let's go back to our IEF example for a moment to show how it works. Read the fund page, and the weighted average coupon is about 2.5%, while the weighted average maturity is about 8.3 years. So eyeball the 2.5 interest rate on the x-axis, follow it up to just below the blue 10-year maturity curve, and follow that horizontally to the y-axis to find the capital appreciation due to a 1% drop in rates. It's right about 7.4%, right? That matches the listed duration of the fund. You could similarly use the same chart to find the capital appreciation for all types of bonds at different interest rates. In plain terms, bond convexity measures the curvature of the lines. Here you can see that while the line for 5-year bonds is relatively flat at all different starting interest rates, the convexity effect gets more and more pronounced the longer the maturity of the bond. 30-year bonds are especially sensitive to rate changes at the low end of the scale, and even with negative interest rates can experience massive gains with only small declines in rates. But this chart is only for capital appreciation, so let's combine it with the first one we discussed earlier and look at the total return including the interest payment. Figure 3 shows the total return with a 1% reduction in interest rates. The x-axis is the interest rate at the beginning of the year, and the y-axis is the total return at the end of the year, including both the coupon payment and the capital appreciation. The result looks like the curved rainbow in Figure 2, resting on the straight upward slope of Figure 1. Moving from high rates at the right to low rates at the left, the total return for short-term bonds descend roughly linearly, while the total return for long-term bonds skyrocket into orbit. To me, this is where it starts to get really interesting. All lines show the total return of a bond with a 1% drop in rates. Look at the total return of a 30-year bond at a 10% interest rate. It's about 20%. Compare it to the total return with a negative 1% interest rate. It's about 40%. Would you have guessed that result? How might that affect how you think about the role of long-term bonds in a portfolio? Of course, with every upside comes a downside, so let's add the results for rising rates. Take a minute to really let it sink in before moving on. Figure 4 shows the range of total returns with a plus and minus 1% change in interest rates. It looks similar to the curved rainbow on the last chart, but the curves are also mirrored below the straight coupon-only line. The lower the starting interest rate and the longer the bond maturity, the wider the spread of results. For example, at a starting rate of 6%, 5-year bonds have a total return between about 3% and 10%. And at a starting rate of 0%, 30-year bonds have a total return between negative 25% and positive 35%. This chart is one of my favorites that I've made in a while, as not only does it contain a lot of interesting information, but I also learned a lot by making it. Here are a few of the most important takeaways. 1. At high interest rates, the coupon is most important, and at low rates, capital appreciation is king. 2. Short and intermediate term bonds, typically capped at about 10 years, are much less sensitive to interest rates at all levels than long-term bonds. 3. Low-interest 30-year bonds are very volatile. In fact, the range of returns is similar to what you might expect from the stock market. 4. Note that the total spread of total returns for long-term bonds is not symmetrical. Because they are increasingly more sensitive with every drop in rates, for the same plus and minus 1% change, they actually have more upside than downside. 5. One thing that's not obvious from the chart is that interest rate sensitivity declines as bonds age. A new 30-year bond will start on the red line. When it only has 15 years left, it has the volatility of the green line. And when it only has 5 years left, it has the predictable tight range of the purple line. Just like people, bonds get less active as they mature. But if you take only one point away from this post, let it be this. Because of convexity, bonds have way more income potential at very low or even negative rates than most people realize. How to apply bond convexity to your own portfolio. So we've talked about how bonds make money and covered how convexity juices the returns at the low end of the interest rate spectrum. Which leads to the most important question of all. Who cares? I get it. Too many articles like this seem to take a weird Android-like joy in the curiosity of the raw math while remaining completely oblivious to what to actually do with the information. So let's talk about actionable insights. How can bond convexity affect you? Here are a few ideas to consider. Rates can always go lower, and a little change goes a long way. If I had a nickel for every time I heard someone say they think bonds are poor investments because rates have nowhere to go but up, I'd be able to buy an island. But the simple fact is that they can always go lower, and because of convexity, they really don't have to move very far at all to turn a major profit. If you're worried about unequal risk, go back up and read point 4 again. At the most volatile maturities, the risk is asymmetrical and biased towards the upside. And always remember that investing in only one bond maturity is not required. Portfolios like the Golden Butterfly use a barbell approach of two very different bond maturities, in part to capture the declining rate upside of long-term bonds with the rising rate safety of short-term bonds. Low interest rates affect different portfolios in different ways. The old school view of bonds is to use them as the trustworthy ballast to temper the volatility of risky stocks, and several portfolios are built with that in mind. For example, the classic 60-40 and 3-fund portfolio both typically recommend intermediate bonds less than 10 years to maturity and ramping up the percentage as you age in order to reduce risk. From the last chart, you can see that these types of shorter bonds do tend to lose their punch as rates drop, so tempering returns expectations may be a good idea. In contrast, a few portfolios like the permanent portfolio and all seasons portfolio, built on the idea of risk parity, tend to prefer long-term bonds up to 30 years to maturity. These portfolios actually benefit from low interest rates, as the high volatility of an uncorrelated asset to stocks is a very desirable characteristic and is a big part of how they work. Investors in these portfolios shouldn't be afraid of low rates. They should embrace them. When rates go low, go long. Even if you invest in one of the aforementioned portfolios that value bond stability, the best answer to low interest rates is not necessarily to sell your bonds and put all of your money in stocks. Instead, consider mixing in some long-term bonds to raise the average maturity of your bond portfolio. As you can see from the chart, doing this at low interest rates will increase both the upside and downside potential of your portfolio, so be careful about adding too much risk. But a little more income potential with a smaller percentage of bonds overall may be a very reasonable balance of risk and return suitable for a lot of people. Adding long-term bonds at low rates could also be a decent idea for something like the Larry portfolio, already incorporating the idea of utilizing small percentages of highly volatile assets to generate returns. Bond index funds sell bonds before they reach maturity for a reason. I know some investors wonder why most bond funds sell bonds before they reach maturity, rather than simply holding them all the way to maturity and collecting the full principal payment. There are lots of reasons for that, but reread point number 5 and look at the sensitivity chart a little, and you'll start to understand why maintaining the right balance of maturities is important for performance, especially for long-term bonds. Allow bonds to age too much, and even long-term bonds that used to work like gangbusters lose their ability to strongly respond to interest rate changes and deliver on the risk-return promise of the fund. For that reason, if you're shopping for a long-term bond fund, one like TLT that maintains an average weighted maturity of about 25 years might be a more desirable choice than one that holds on to the bonds a little too long and the income potential suffers as a result. Phew, that's a lot of info. Some of your heads may be spinning, others may have questions, and I imagine those of you in the finance field might even have spotted a few details that seem oversimplified. The truth of the matter is that bond index funds sound simple in theory, but are actually kind of complicated to run in practice. And because of the specific bonds owned by a particular fund and variations in payout details, the results may not perfectly track every assumption in this article. While bond fund weighted averages should map to the charts reasonably closely thanks to the very high liquidity of the funds, definitely don't take any precise data as absolute gospel, but instead think of it as opening the door to a new concept. Bonds are a lot more fascinating than even I knew before writing this post, and I hope you learned something too. Thanks for listening. If you'd like to learn more about this or any other asset allocation topic, please visit portfoliocharts.com.